Sabio is an ad tech company providing technology and services in the fast-growing ad-supported streaming space. CEO Aziz Rahimtoola and CFO Sajid Premji are here to join me and do a deep dive into their business, operations, and the industry. I'm Martin Gagel with Market Radius Research. Please remember this is neither a recommendation nor investment advice. We're here to learn about the company. Aziz, Sajid, welcome.
Thank you, Martin. Thanks for having us.
All right, great to have you here. Yeah, I'm really looking forward to it. I've never really dug deep into the business. I understand the concept of it. I always get a little confused by ad tech. There seems to be a lot of black box stuff going on. So I'm looking forward to sort of teasing apart the different pieces of it. So why don't we start off with you guys walking through the deck as the sort of the setting the table for the understanding, and then we'll dig into things.
Great. Sounds like a plan. And I'll do my best not to ramble on my answers as well. So just,
Okay,
just so you know.
it's a deal.
But before we start, I would love to give just the group a little bit of quick background of myself. I started my career at Fox Television, actually a rep firm before Fox Television. Spent 3 years at Fox Television on the traditional TV side. Went over to NBC for 6.5 years, traditional TV and digital, and then was recruited to AT&T when they got the iPhone. To help them launch that business, the display business there, and then went over to operate the browser company before I started Sabio. So, my background is I really have always believed in this idea of TV, traditional TV, and interactive meeting, and that's what ad-supported streaming is. And we'll get into that a little bit more. Sabio is a company that's growing in the ad-supported streaming space. And what is the ad-supported streaming space? Ad-supported streaming, think of the ads you see on a Roku device or on Fubo TV or on one of these Samsung Plus when you go in and you see that channel. Those ads are ad-supported, meaning that content is free to you based off of the ads that we place in there. And what Sabio has positioned itself in this growing space, and it's growing very fast, and we'll get into the numbers, but that's really what we do. We work with the brands and agencies to help them reach audiences on ad-supported streaming. Now, if you can imagine, people are cutting the cord at an ever-increasing rate, especially in the US, which a majority of revenue comes from. Outside of now, we're seeing a lot of growth in Europe, but that's the core business. Last year, we did 49.6 million of revenue. That was up 30 in full year 24, and first half 25, we're up 33% year to year. Adjusted EBITDA profitable 4 out of the last 5 years. So we're not only this company in the ad tech space that's growing and taking advantage of cord cutting and the opportunity that presents, but we've done it for the most part 4 out of 5 years profitably. And we've done it based off of just raising 7.2 million via an RTO in November 21. And then with that has led to a 39% growth rate since 2020. And 37% non-election years. We've grown 37% in non-election years, 66% in US election years. Now, US elections are a little different from the Canadian market in the sense that there are elections every 2 years. And so the elections are set. And so we work with some of the biggest names that in the US market to help them run campaigns. And we'll get into why. And we have 120 people across the US and globally. We have offices all across the world, 124 people is our footprint, including some of our biggest expansion opportunities, including Europe and now India. In India, we've had a fully owned subsidiary since 2017 that does operations, data science, and analytics. And what's unique about that is because we have a fully owned subsidiary, we as a company can actually start doing work in the Indian market from an advertising perspective without needing to do a joint relationship with another company. So we're set up to expand all over the world. Next slide. We have a great team, and this team has backgrounds from AT&T, Opera, Fox, CBS, just to name a few, and ABC. And so we have a combined 175 years of experience. So we got the right team in place to really take advantage of the growth we see ahead for ad-supported streaming. We have also a great board of directors. Paula Madison, former GE officer, senior levels at NBC Universal. Carl Farrell, the former CRO of SAS Institute. Moez Karaj, managing director, technology, digital media. Gonzalo Delphi, president of Group M Multicultural, which is the largest holding group in the world for advertising. And Matt Hall is the chief data analytics officer at Chamberlain Group, which is a Blackstone-backed $5 billion company. So we have an amazing group of directors on top of an amazing group of leadership. And what we're really taking advantage of is this opportunity. It's the massive streaming opportunity. And the growth and the opportunity we see is endless because simply cord cutting is increasing. And while people are certainly using YouTube and they're using that as a platform to watch content, they're also using ad-supported free streaming apps. Like I said, Plex, Roku, Vizio, and a number of other apps. That's what they're using, and we're taking advantage of helping provide the advertising in those apps and some of the analytics and data. And how we're doing this, our strategy is synergy. We built our own ad platform, the ad server, which is Sabio. That's how we started the company. From there, we built analytics that is unique to us, that creates audiences and insights and targeting. And most recently, we launched our own channel. And what you see here is, we have a complete end-to-end stack that is providing for us, giving us an opportunity to have 92% reoccurring revenue model, whereas App Science also gives us unique insights and data for our clients, which is critical, especially in tariff environments as such. Clients want to know how effective their campaigns are and to effectively reach consumers, more effectively reach consumers, and that's what we're doing. And then finally, Creator TV, our own channel, which we're taking some of the biggest creators from YouTube and bringing them into the streaming space. And why that's advantageous to us is because we have the ability to monetize that through our ad server. We have the ability to provide analytics. And now we have our own channel and our content play. So it's really a combined cohesive strategy here that we've been building since 2015. And we work with some of the biggest brands in the world. And this is probably the most surprising aspect for a lot of our customers and clients, or at least our investors, is to know that we work with the GM. We've been working with GM since 2016. We've been working with Taco Bell, Starbucks, Dentsu. We, in fact, work with Meta. We work with some of the biggest brands in the world. And why they use Sabio is because Sabio not only provides great ad serving and reaches those audiences effectively, we provide insights and analytics. And that's all driven by our App Science measurement and proprietary household graph. And what a household graph is, to simplify it, it's a data graph. It's an 80 million data graph across the US. Now, to give you some context, Nielsen has a 40,000 panel versus an 80 million big data graph in the US. That's our value proposition. That's our key differentiator. And that is why brands like McDonald's, Starbucks, Taco Bell, they like using Sabio, and we have a 92% recurring revenue model. And where we run those ads on platforms like Pluto, Vizio, Roku, Fubo, and more recently, we also run the ads on our own channel, which is Creator TV and Creator Sports. And so it allows us to really look at our bigger picture. Our gross margins on average when we run it on the other platforms are 55, 66%. And the launch of Creator TV, which just happened January, is one of the fastest growing creator networks on streaming today, gives us a 70, 80% margin. It's still early. It's still new. We'll talk about the numbers in a bit, but really it is one of the fastest growing platforms in the streaming space today. And going back to, it's always about the data, because in any time, and the efficacy of a campaign is critical. Efficiency and efficacy is really what our advertisers are focused in on. And what we really love to talk about is this household graph. It is about we take 280 million mobile devices on a monthly basis, cross-reference them by 115 million CTV households to give us 80 million rich homes across the US. And what we do is we validate the data. And so it is about validated data, the quality of it, and the effectiveness. And that's really what differentiates us. And that was not enough. So we wanted to go ahead and expand what we were doing. So first, we expanded geographically. If you looked at some of our numbers up until this year, we were 100% dependent on the US market. That's not the case anymore. We're seeing a lot of growth in international markets. Sajid will get into some of the details there, but we're seeing a tremendous amount of growth. Our programmatic business is growing 94% since January, and this is a different form of advertising. And for your audience, managed service is one component where the client sends you an insertion order, you run that insertion order your platform. Programmatic, on the other hand, is we're running those campaigns through other platforms. We still leverage our platform to get the data and the inventory, but now what it's doing is it's helping brands use us in the environment they want to use us in. So that means using us through the Trade Desk, using us through Google. We are now partners within those environments that allow them to easily access the data and the inventory that we can provide uniquely from us. And then finally, Creator TV, 300% increase since January. We're super excited about this opportunity in this channel, and we see a lot of growth ahead in all three of these components, which is exactly what we've done. We've diversified our business, and that is what we've invested in since end of last year and really this year, is to do this diversification, and it's paying off. Sajid, I'm going to hand it over to you to talk a little about, these three components. If there's anything else you want to add. Oh, sorry, business execution. Yeah, Sajid, business execution.
Thank you, Aziz. And Aziz has touched upon at the beginning of the presentation. We went public in November 2021, and we raised a relatively small amount of capital, $7.2 million net of fees, and we at a $70 million US valuation. And that was coming off a year that we did 13.2 million US of sales. We used that funding to really transform our business and to propel our growth. Since 2020, we've had a top line growth of annual growth rate of 39%. Meanwhile, just EBITDA margins culminated in 8% in this last year, putting us firmly ahead of the rule of 40. We've transformed our business from a business that was doing 10% of our sales from ad-supported streaming TV to now over 70% of our sales from ad-supported streaming TV today. And what we've done is
Sajid, sorry to interrupt. Just for people who don't know the rule of 40, could you just quickly explain what that is?
Yeah. So the rule of 40, Marn, is in the audience is basically a rule that investors and VCs use to judge the health and growth potential of a company. Usually, if you have a top line growth rate plus EBITDA margins over 40% combined, you are a rule of 40 company. And that's what we've been able to achieve since going public in 2021.
So if you've got 20% growth and 20% EBITDA margins, you hit the 40. You've got 39 plus 8s, you're at 47. So you're well beating it there. All right.
That's correct. Yeah, thanks for clarifying that. And we've accomplished the rule of 40 growth by really capitalizing on the continued movement of eyeballs from linear TV to streaming TV. Again, as I mentioned, streaming TV now composes over 70% of our sales mix. If you look at how we've done that through a couple of different ways. You have these off-election years and a strong brand of the business, serving the likes of McDonald's and Toyota, and they come back year after year. We have a 92% recurring revenue rate from our branded customers. And that has propelled a 37% CAGR in off-election years, well above the 13% growth rate of the US CTV market at large. Number two, just as the app science data that Aziz touched upon is important for brands and advertisers, it's just as important, if not more so, for a political campaign trying to bring out their electorate in a polarized field. To that end, we're seeing a compound annual growth rate of 66% in election years, up to this most recent 2024 election year. In 2024, we really saw both ends of this come together. Looking at the full year, we grew our top line by over 38% to 49.6 million US, or nearly 70 million Canadian. Again, that's well above the 13% growth rate of the US CTV market at large, which means that we're taking market share. Ad-supported streaming TV, our primary growth engine, increased 60% to 38.6 million US in 2024. For some context, in 2023, we had 36 million of sales across all sales categories. So in 2024, ad-supported streaming beat our previous record across all categories. Meanwhile, we held our gross margins steady at 60% while holding a 90% recurring revenue rate. 70% of the top brands that spent with us in 2023 came back to us in 2024 and spent more money with us. So not only are the brands coming back in high numbers, 92%, 90% last year, 92% this year, but they're spending more with us. And this really evidences our ability to land and expand. And to that effect, 41% of the logos that spent with us in 2024 were new logos to Sabio, giving us great growth potential in the upcoming years to grow upon that base. And as revenues ramped up between 2023 and 2024, so did profitability. We saw a material swing going from a loss of 1.8 million in 2023 to an EBITDA gain of 3.8 million in 2024. Now, as big as that swing was, we believe next year has even more potential. As Aziz had touched upon, going into 2024, we only had one core offering, a managed service offering that was primarily domestic driven. Our UK sales in 2024 was only 1.4 million US. As we said publicly, over the course of this year, we expect to triple that 1.4 million this year in 2025, and we are well on our way to doing that. And so, if you look at about 4 to 5 million, that's going to be the base that we start off 2026 from. Again, as Aziz mentioned, 90% of all ad spending is done programmatically. Moreover, most political spending is done programmatically as political campaigns want the flexibility to turn on and off the dial and switch strategy along with their campaigns. Again, in 2024, we did not have a programmatic CTV OTT offering. This is going to be brand new to us next year for a political season. As Aziz mentioned, we launched it in this year, and it's already seeing over 90% month-over-month growth rate. And we expect by Q4, it will compose double-digit portion of our sales mix. And for the glimpse into the growth potential of these products before any political tailwinds, you only need to look at our first half results. We grew our top line by 33%, from 15.2 million US to 20.2 million US, or 35% normalized for political spending. Ad-supported spending grew 24%, excluding political, 21% overall, while our high recurring revenue rates again improved further than 92%. As a component of this, our international sales quadrupled over the prior year in Q2, while, as I mentioned, our programmatic offerings saw a 94% month-over-month growth rate through the first half of this year. And this kind of takes us to where we are today. In Q3 of 2023, after a tough Q3, our stock reached a 52-week low. And if we sold it then, entering into a political year, it would have been a losing trade. Our stock has since doubled. Even despite that appreciation, we believe that we're still heavily discounted. In fact, looking at these stats, even more discounted than we were in 2023 going into 2024. We are trading at just 0.4x sales this year's and next year's estimates. On next year's estimates, we're trading at 4.3 EV to adjusted EBITDA. The fact is, in 2023 going to 2024, we showed that we could turn our investments into big bottom line gains. And now entering into 2026, we're a much better company in all respects. We have a new programmatic offering, an international business that's growing at a robust clip, a new streaming channel in Creator TV, and now we have those political tailwinds behind us as well. And 2024 again was our first year of actual political sales from campaigns. Now we are an established player in the markets, and we're expecting further growth ahead.
And to Sajid's point, we are that company that continues to invest. We can go back one slide, Sajid, to just talk about this. We are still very much a growing company, and we're growing fast. And that requires investment and constant focus. And we are doing that. And what you will find with us is we look at the off years as an opportunity to put investments into the company, as we have done this year and continue doing. And then we reap the benefits of those investments next year in a bigger way. And that is not changed because, once again, while we would love to be focusing on just optimizing EBITDA, we do see a bigger opportunity and we're continuing growing. But we have demonstrated, as we have in the last 4 out of 5 years, we know how to get to profitability. We can do it at any time. With the majority of our costs sitting on labor costs, we have levers that we can pull at any time. But what we want to make sure the audience understands is that we are we're a growing company that has a lot of opportunity. And so we choose not to use these levers to simply deliver EBITDA, because the bigger opportunity, quite honestly, is the incredible amount of growth that we have grown, while we can also demonstrate we know how to be profitable, and we will continue demonstrating that over a 5-6 year cycle.
Thank you, gentlemen. Great overview. I guess starting off with on your last point there, and something you mentioned at the front end of the presentation, your staff. You've got a good size staff. I would guess you've got some admin, but it's largely broken up between developers and sales, business development. Is that sort of where the big chunks of the staffing is?
That's correct. It's in engineering, it's in data science, and sales apparatus. And most recently, we added in at the end of Q4 and in January, we added significant headcount on the sales apparatus. Now, what happens traditionally, it takes us 6 months to 8 months for those sellers to start getting ramped up overall. And so we are now just starting to see the benefits of that at the tail end of Q3 and really Q4. But really, where the benefits of that is really going to be fully felt is in 2026. And so we're seeing that benefit of our core business. We're seeing the benefit of course, political headwinds. And, that's to say we didn't have challenges. Q3 was challenging. The tariff environment, although we demonstrated, significant growth in the first half of the year by delivering 34% growth year to year in the first half of the year, we did face challenges in Q3 and we navigated that. And we're feeling so much better about where things are at as it relates to Q4 and especially as it relates to 2026. So, we've navigated some tough environments and, we just want to make sure the audience is very clear. It was not a cakewalk, but we did the things we said we would do. We executed on our strategies of diversifying our media mix, our revenue mix, whether it's geographically or product basis. We set out to do certain things. Those things are achieving growth and opportunity, and where we see the real impact of them starting to be felt is in Q4 and especially 2026. So, we're super excited about 26, but we do also want to be, very transparent about the challenges that Q3 we did face in that respect.
Yeah,
All
I
right.
think, just to bounce off what Aziz is saying, if you take a step back and look at the company overall, we are a much better company today entering to 2026 than we ever were going to 2024. Again, we only had one core offering back there. We are more diversified from a product perspective, more diversified from a geographical perspective.
All right. And so when you ramp up drive growth, that is investing in salespeople and business development to build new. What does the sales like? It all sounds very electronic, programmatic, but is this old-fashioned? They pick up the phone and call NBC or McDonald's and say, "Hey, you want to work with us," or is it all kind of online digital stuff?
It's a little of both. So we have a 92% recurring revenue model. And so that basically, at least for the first half of the year, when we get clients, we retain them and we grow share of voice. Of that 92%, 70% plus of those brands, as late last year, and we haven't done enough of the stats, we're getting that it's still early, but 70% of those brands did add additional spend in wallet. So what we find is once we get into the door, we're able to harness that and grow it. And so to answer your question, a salesperson is leveraging that to open up other brands in that same ad agency or other brands at the client level. And so, it's a little bit both. It's about reaching out directly via email. It's word of mouth. Hey, we've noticed you've done really well on this campaign. We'd love to try you on a different brand. And we're having a record number of, we are going to talk about this in our calls, but we're seeing some really good trends as it relates to new nameplates. And so we're really expanding the reach, partly due to these new sellers we have in play overall.
All right. I'd like to dig into app science a bit with your 80 million validated households in there. A graph is essentially a kind of a complex, multi-dimensional database with lots of information per household. And then the more you know, the better it is, and the more value you can charge by targeting specific demographics.
That's correct. And it is really big data, but it's done in a privacy compliant way. And our approach to big data has always been to make sure we have the opt-ins, we have privacy compliant, and approaching this in the most thorough way we can to really understand those audiences. And some of this, quite honestly, is we have certain signals that we know are coming out of their home. We're cross-referencing with other signals and other data providers to really build a better understanding of that household. Now, where we don't What we stay away from is building profiles on individuals because there are some sensitivities to that. But on a household level, that's really what we're focusing on, is understanding the behaviors of that household and the consumption patterns, both from a video consumption, a product consumption, or just a visitation consumption. Kind of, you visit these locations, you're a hiker, you have hiking apps, you're likely, and you visit hiking locations, you're likely to be an avid hiker. There's those kind of inferences we make off of data.
All right. So, and that's obviously, so I will see different ads than my neighbor or the guy across the street from me based on what sort of household demographic flags were triggered.
That is correct. And the idea is you
Okay.
are going to be part of a segment, a category of people in certain categories. People who, have a dog, people who are married, people who have kids. There's certain segment categories that we then group people into, and then add to that some lifestyle behaviors. You're more likely to be an avid sports fanatic because your consumption behavior is sports, and you have these sports apps. You're likely to be someone who is in the market for an automotive vehicle because you're watching a lot of automotive content. At the same time, you have, cars.com, or you are an avid fast food junkie because you have a bunch of apps. We know you have these two apps, and we see the visitation to Taco Bell on, and you're part of a grouping of people who go to Taco Bell. I'm not saying you do, Martin, because I have a feeling you don't go to Taco Bell, but the idea is like the assumption of people who go to certain categories. And then what's interesting about those, we're making some assumptions, but we're also being able to really understand that consumer behavior from a consumption behavior perspective from TV and what we're seeing on that set top. We have now partnerships that allow us to see data, like what are you watching? Great. Those partnerships then hand us the data and say, okay, these are the homes that are watching in a privacy compliant way, these type of shows. That then connects to that app profile data that we have. And so we really have created what clients really want and advertisers, consumers want, is if you're going to send me an ad, make it pertinent, make it relevant. The engagement rates are higher when that happens versus sending me an ad for something that I don't find very valuable. I don't go to single bars anymore or whatever, right? Like that's not an ad that would resonate. That example, but something along those lines.
And is App Science only for like targeting your like the streaming ads that you present on the streaming platforms, or do you, I don't know, rent it out or let other people use it then to target through other advertising platforms, or is it basically you only use it for accessing the rest of your platform?
So because we are very focused in on being GDPR and CCPA compliant, we are not comfortable with sending our data to other platforms to use. We only house it within our platform to reach those consumers that they want to reach. Separately from that, we do provide an analytics tool for advertisers such as Toyota, who uses our platform today to help them understand Asian audiences better. So we do have some component of our platform that's used for insights and analytics. But as it relates to, especially to reaching audiences, we have always shied away from just sending our data out to other folks because we want to make sure we have custodial control of that data. We know the power of it. And so we're always very mindful of privacy as it relates to that and how it's being
You're
used.
you're expanding globally, I guess initially is in the UK. Do you need to have a household graph of the UK or the new markets to enter it, or is that something that you can kind of backfill in later, or that's maybe it's just something specific for the US market?
So we have a version we call App Science Lite. And App Science Lite essentially is a collaboration with other data providers in that marketplace. And when we say UK, we're talking about Europe as a whole. And so
Okay.
because it's a heavy regulated, even more so than US, GDPR and CCP compliant, the regulations are a little different. We wanted to make sure that we went into the market, we were approaching it from a compliant perspective based off of the market needs. Now, having said that, we are actively working on launching our own App Science Graph in Europe. We're seeing tremendous amount of opportunity and growth, and we want to provide the insights and analytics that the clients in the US have come to appreciate about us and provide a stickiness to that. So we're super excited about that. The teams are working on it. We expect that to come to fruition sometime next year.
The bigger that graph gets, the more valuable it is, and then you can charge a better premium because you're better targeting the ads. They're more valuable to the advertisers, right?
That's correct. And they're quite honestly in that marketplace, just like, as I said, 40,000 panels is all 40,000 survey panel is what Nielsen has in the US, as big as the US is. And we have an 80 million household panel in the US. And what we're finding in the UK market and European market, there's no existence in that. They don't have the insights that we can provide, and we see a huge opportunity there. But that, as it goes back to my point of being earlier, that takes investment. That takes, forward spending on things that we know the market needs that we will address. But when you have a opportunity that's as big as $40 billion, and it's growing fast, this is the fastest growing segment. The ad-supported streaming space is one of the fastest growing segments within the media landscape. And we see a huge opportunity. And no one's waking up in the morning and saying, hey, you know what? I really love my cable bill. I'm going to keep this cable bill going. They're waking up and they're asking themselves, what do I watch cable for outside of sports, especially in the US? And so you're seeing an increase of cord cutting taking place and alternative avenues, especially if you're under the age of 25. The likelihood of you actually having a subscription service is very slim to none. You're using YouTube, and now you're having these ad-supported streaming apps, Netflix, Hulu,
Yeah.
all of those guys.
Do you get access to, like when I'm on Amazon, I get a few ads. Are you able to place in there, or is it more the Roku's? I don't know if it's fair to call them the tier two, but do you get into like on the Disney Plus and that, or is it the other platforms that you help target?
We are now getting access to some of the biggest platforms, including Disney Plus. We're on Universal's app. So we are on a lot of major apps now, and as we continue to expand, we're getting opportunities to help fill some of those other platforms. And as it relates to Amazon Fire, our channel is on Amazon Fire. Creator TV is on Amazon Fire today. So,
Yeah.
while we are not placing the ads per se on that, we're going to be doing, integration opportunities there. We're actually, launching, which we just announced, a collaboration with World Poker Tour in December. And that World Poker Tour is a well-recognized game that takes place every year at the Wynn Casino. And we're going to be collaborating with them on doing an edition of that for Creator Sports. And if you can imagine, if you're a brand, this is the kind of stuff that gets you excited to do some things that are different. That content lives virally outside of our platforms, and including at some point living on YouTube. So it will be everywhere and anywhere. Our view is we're going to monetize it in so many different places, because you have to, as an industry, if we're not moving as a company, we are not adjusting to how consumers want to watch us, then they're not going to watch us. So let's be where they want to be, not where we want them to be.
Is there a problem with you've got your own channel and you're driving that you're competing with your clients and sort of taking eyeballs from there, or is that an issue at all?
No, and our clients are the biggest brands. So our clients are the GMs, the Fords, the McDonald's. And what we're running those campaigns are on other platforms. And so those platforms are not our clients, they're partners. And
Oh, okay.
for them, we are helping them monetize their inventory. We're helping them analyze their inventory a little bit better. We're helping them provide insights. And so they want to continue working with us, because we still are, while Creator TV continues to expand, today, the biggest portion of what we do is we use inventory on all these other platforms, and so the Samsungs, the Vizios, the Plutos, and all of these other platforms combined. And so that's who we are today. And as we continue growing, we believe there's also partnerships with them and collaborations, because the CTV space is one of collaboration. There's a lot of cross-pollination. Our show, Creator TV Sports, World Poker Tour, is going to be on Fubo in some capacity. We're not competing with them. We are on Fubo because it's another distribution vehicle. So we see more collaboration than competitiveness. And the best part about this industry is it's growing fast and there's a lot of opportunity. We are taking market share based off just our overall growth in the space, despite being such a small company.
And so I'd like to keep things really simple so I can understand them. A McDonald's or a big brand will come to you and say, "Hey, we've got these ads, whatever, a McHappy Meal we're trying to run a promo on. We want to get it out to, I don't know, we've got a X million dollar budget for it." They basically then say you find the best places to put these ads on ad supported TV, and we want sort of these kind of demographics, and then they'll pay you every time one of those ads goes out a portion of that.
That's correct. So the way that works is they will exactly what you said, Martin, is like, look, we're looking to reach this audience. And we have seen now the one thing to keep in mind, McDonald's, 40% of their revenue comes from their app in the US. And so they are now interested in working with us to help drive certain audience segments. We want to help reach, let's use, moms with kids for potentially pushing the Happy Meal. They'll say, Sabio, we need you to reach this audience, and it might be general market, it might be Hispanic. Help us reach this audience. We identify who are the best homes that is going to be receptive to that ad. Our ad server will then serve out the McDonald's content, the ad spot. They'll serve it out to those homes. McDonald's will do their verification. We will do our own verification. We'll provide McDonald's additional insights, and that's how it gets wrapped up. They pay us, then we are running those spots on platforms like, once again, Samsung, or, in some cases, we're running on Netflix. And so we're running on different platforms across the board based off of the needs of that advertiser.
All right. And if I don't know, one ad costs a cent or a dime or whatever to drop into someone's home, that if it's going on to Hulu or something, Hulu gets that 10 cents because it's their platform. And then you get a fee for placing it there. And that 10 cents doesn't run through your financial statement. Does it? Just the service you charge? I'm just trying to understand what the revenues are. You only get recognize the revenues for finding a home for the ad, not the actual value of the ad itself, right?
Sajid, you want to cover this point?
Yeah. So the revenues that we get for the ad are basically based off the impressions delivered, right? So basically at the top of the campaign, we'll get a budget from McDonald's. They want to run, a campaign, to reach a certain audience, and they might have like 100K budget for that campaign, right? And it's based off, a certain number of impressions being delivered on that campaign. And so what we'll do is we'll deliver those impressions, those views, to reach that audience. And that's where the app science graph comes into play, because we use that data to find their audience that they want to reach, right? And so we use app science data. We'll place the ads on our choice of supply partners. Maybe it's on an app on Samsung, maybe it's Fubo TV, or maybe it's on Creator TV now, right? There's a highly desired demographic on Creator TV, Gen Z age range, and so we may place it there. And so at the end of the day, once we place the ad and once the impressions are delivered, what we'll do at the end of the campaign or at the end of the month, we'll build a customer for those impressions delivered. And then
now, with the exception of that, is when we run it on our own channels and some of our, what we will do is in that instance, McDonald's will say, we need you to reach these audiences. We will then use our own channel in addition to other channels to reach that consumer on there. And then, but in our case, it's our channel. So now we do a rev share with the content creators that have created that content that we've worked with them to partner up with. And that's where the business model changes. So that's how our business model is evolving from simply paying for the spot through some of these other platforms to now benefiting from sending traffic to our own, channel.
Yeah, I think to this point, an easy way to look at it is that, we get $100 from McDonald's. We pay $40 to Samsung for the spot. That's $60 a keep. If we do it on our own channel, we basically, take $100 from McDonald's, but we only pay $20 through a rev share to the creator. We have an 80% to keep. 80% our margin. So that's
gotcha. So if it's your own platform, you keep a bigger chunk of it.
That's exactly right. And I think, and that's the way to the good part about us, Martin, is we're constantly a company in change, in identifying opportunities. And that certainly, once again, takes investment, but we see a huge opportunity here. And our clients have said to us, this creator TV channel is exciting. We want to be part of this. Certainly, we want you to do what you're doing for us already and keep executing using data science and analytics. But with now having multi-dimensional focus, it allows them to say, you know what, we're going to give you some separate money for this new opportunity beyond what you're giving us. And so these are all growth opportunities that have propelled us and are growing, but some of that does not show up in a meaningful way yet. It's showing up, we believe, in Q4 and then next year, especially.
All right.
Yeah.
I like this channel. My channel is on YouTube, and then I've seen and other people like on Google Ads and so forth, and or if you're advertising on Amazon, this is not sort of your type of content, but sometimes they change the algorithm all the way, and every say,
Right.
oh my thing, this just blew up, and I gotta figure out, I gotta redo my SEO. Are you dependent upon anyone like that, where an algorithm could get changed, and all of a sudden it could like, oh, you're getting
No.
midnight calls and like, hey, we got a problem here, or are you running your own algorithm and you're separate or insulated from
Yeah,
that?
and that's actually what we're solving for, Martin. What you just described is the problem a lot of creators have. Now, the creators are the current celebrities of the media world, right? And the
Yeah,
challenge they face is when they're on TikTok or YouTube, tomorrow the algorithm could change, and now it affects them.
yeah,
And so part of what they see in us, this is why we've gotten some of the biggest influencers to join us. It's not exclusive to us, but exactly that's what we're solving. We're solving for two things with our channel. We're solving for the algorithm taking them down tomorrow and not being diversified. That's what they appreciate. What we're also solving for is for the brands and agencies who want a curated experience. Sometimes you're on YouTube and the stuff that comes up is not what you signed up for. It's not what you
yeah,
expected. I don't let my daughter watch YouTube for that same reason. That stuff comes up there based off of what is not good for her. It's good for the company. In our case, this is a curated experience that our brands could rely on the quality of that programming and what they're seeing. And the question I get asked, especially by younger people, is I use YouTube. Why do I need your channel? Why would I watch this on an app on a TV when I got YouTube? And the answer is simply this. Don't you hate it when you're watching and you're getting into like one of your influencers and all of a sudden it gets knocked out by some other influencer that you don't care about? Don't you want to watch more of that influencer and continue? Yes, great. Well, this is a curated experience that allows you to think of it as binge watching, right, of influencers, which you don't really get an opportunity because you get all these distractions on YouTube. This is a curated experience that allows people to say, hey, cool, this person is on again. I'm going to watch some of this. I'm going to watch them on VOD. I'm going to watch them on the Creator TV's channel, but I'm going to also watch it on the Creator VOD channel. Here's some additional things. I want to know this creator even more, and they're doing some unique things on this outcut, this World Poker Tour. This is the first of its kind. This is where people get to see their creators, some of their favorite creators, in an environment that they've never seen them before, playing poker at the Wynn Casino. That's the opportunity, that it is this idea, and that's under the Creator Sports umbrella, which we're super excited about, is this opportunity to rethink sports every way possible. And it's really, once again, it's part of our innovation process, who we are as a company, especially since we have the analytics to back it up. That's what gets exciting.
Mhm.
all
Yeah,
right. And
there's
then
parts of the spectrum there. There aren't really any peers that I see who have all the aspects that we have. We really have the complete ecosystem, right? We have the ad serving with the brands. We have the ability to, place an app on these platforms and actually monetize these ad spots. We have the data coming in, to help these brands target their audiences and help creators also get a feel for their usage base. And then we have our own streaming channel as well, right? There isn't anyone out there who has all these components.
And going back to the streaming channel component, because we're getting opt-in data, now we're getting even more richer data that then helps our graph. And so this is all interconnected. The idea of better understanding those audiences through different lenses. We're the only company in the whole space. Crazy, right? Watch, Martin, this is the crazy part about this whole idea. We're the only ones who are getting creator information into our graph that then is providing that for insights and analytics for our brands. There is no other company in the space that's doing it. There's listening data. You can get listening data, but you can't actually get creator-driven data that allows you to understand those audiences more effectively. like we can. And that's what really continues to harness our differentiation in this space. And we're super excited about not only doing that in the US, but now doing that in Europe in a privacy compliant way.
And being
All
the only
right.
one is
So
very important, right? Because I mean, if you're pitching to a brand or an agency, it's all about what differentiates you from someone else, right? Why spend money with Sabio when you can spend it with someone else? Well, you spend it with us, you get the whole package, right? You have the DSP, you get the analytics, and you're able to now access your own O&O content through Sabio's streaming channel.
So you're growing your share within the US, you're growing your footprint internationally, and then next year, is that when it starts next year, the ad spend on US elections? And when does that, like, unlike, I think, oh, I'm quite sure, any part in the amount spent on US elections is multiples times the per person, per voter you spend in any other country in the world. And they're just trying to get ads to the right homes, get them out the door, and you just participate in a slice of that market.
That's correct.
Aziz, Sajid, thank you very much. That was a great overview. Any final comments here before we wrap this up?
Look, we are a quickly growing company in a $40 billion plus opportunity that the marketplace has. And we are doing the right things with differentiation and uniqueness. And with the 90%, 92% recurring revenue model that continues to pay dividends. So we're going to continue growing. Absolutely, we're going to need to spend on that growth. But what I would say to investors is, look, this is all set up for 2026. We're set up in a big way for 2026, as we delivered in 24, coming out of a tough 23. This was a tough, while we grew revenue, this was a tough year with tariffs and a lot, but I'll tell you, we are so set up for next year, and I think we're beyond excited.
Thank you, guys. Thank you very much for joining us and giving us a great overview on the company. Have a great day, and I'm looking forward to talking to you again soon.
Thank you, Martin. Bye.